Hello everyone, in front of you is the Bitcoin chart which we analyzed in the previous video. I promised to take a look at the US stock market. We will be looking at the Nasdaq-100 index, which is in a way Bitcoin's twin brother in the stock market. Why? Like Bitcoin, it has higher volatility, and there are high growth expectations priced in for many of the companies included in this index, particularly those in the field of artificial intelligence. A very popular topic today. But these expectations do not always come true, and when that happens, the index can drop significantly. On the QuantFury platform, where you, just like me, can trade without commission, the index is represented by E-mini futures. So we type Nasdaq in the search, and we see Nasdaq-100 E-mini. Futures have a particular feature. They have a start date for trading and an end date, the expiration date. That's why the chart is rather short. But we won't be looking at the index itself. Instead, we'll be looking at an ETF fund that's based on this index, and the most well-known of them is Invesco. Its ticker is 3 letters. Q, very easy to find. Here you go. So let's start with the weekly candles, because the chart profile of this ETF fund's stock completely matches the profile of the index itself. Accordingly, if the stock shows a 10% drop, we can very likely expect that the index chart experienced the same decline. Weekly candles. We'll look at both weekly and monthly charts. What do we see here? We see that around November 3rd, a rally week began when the index had been falling for 3 consecutive weeks, and this happened after it reached a new all-time high. This decline ended with growth. Let me zoom in. This decline ended with growth during the week of November 24th, which engulfed the red candle of the drop. And this week, the green week, is notable for forming a support level, breaking which would send us back into a downtrend. And look, 1 week, 2, 3, 4, 5. For 5 weeks, we couldn't break through this level, and as soon as we did, the movement accelerated and intensified. And now the 50-week moving average has been broken. And considering that this index has already moved to the 100-week moving average and even significantly lower, the chances of reaching the 100-week, and given the situation in the Persian Gulf, even the 200-week moving average are very, very high. That's if we look at the moving averages. If we look at important technical levels, the most significant and nearest one is this one. This is the $530 per share level for the ETF fund. Why? Because, look, we established this level during the uptrend, then it held us back from further growth for a long time, then we saw a false breakout, after which there was a dramatic move downward. Accordingly, this level is important for us, and it roughly coincides with the 100-week moving average. Now let's try to estimate in percentage terms what the size of this drop would be. Well, relative to current prices, that's about 5.5%. We can use this figure as a reference point. But if the decline continues to the 200-week moving average, that would already be about a 20% drop. And if it continues to the 300-week moving average, that would be around 30%. And believe me, that's really not much compared to the situation that could happen, and is very likely to happen, given the events unfolding in the Persian Gulf, the war between the US, Iran, and Israel. Now let's look at the monthly candles. On the monthly candles, I would draw your attention to the following points. Here we had a wave of growth, which ended in October with a green candle, after which the index stopped rising. But also on the October candle, support was formed around the $597 level. If we look at this situation from a closer perspective, we can see that for 1, 2, 3, 4 months we were unable to break below this level, and only in March did we break through it, forming a bearish engulfing of the October candle, and almost immediately reaching the base of the September candle, which was the next technical target. Here and now there is not a single reason to buy. The RSI is pointing down and it is clearly not oversold. We have a full-fledged bearish engulfing, which means the next technical level, at the very least, the absolute minimum, is $549 per ETF share. But the more important level is the one from which the index reversed last time, $522. With regard to the Nasdaq index, this number itself doesn't mean anything, but we can take the size of the drop as a percentage relative to the current price and see that it's 7%. So a 5 to 7% drop, well, you don't even need much imagination for that. But Notice that the index has already dropped into the area of the 50-month moving average, which means that a 5 to 7% decline is just the beginning, and there's a high probability we could see a drop to the 50-month moving average. And that's still the same 20%, in this case 23. But the average is trending upward, and over time it could be a bit higher next month. But the drop could be even deeper, around 40% down to the 100-month moving average. The key point on both the weekly and monthly charts is that, from a purely technical analysis perspective, there is absolutely no reason to buy right now. And if we add the situation in the Persian Gulf to these charts, we'll realize that the shock wave from the war the US started against Iran hasn't even reached the real economy yet. It's only just beginning to build up, like a tsunami that's still out at sea, but soon this wave will hit the shores of the real economy. Trade carefully. If you choose the Quant Fury platform for your trading, just like I did, I'll be glad to hear it. Goodbye.